who you sell to matters.
Especially if you're sticking around.
Especially if you're staying around. There's a time and a place for venture capital, and there's a time and a place for buyout. And so someone who's got a diversified portfolio would include elements of all. But for someone who can only make one investment, that's probably the most riskiest part of private equity is the venture capital, because we're looking for home runs. I'm a turnaround person, and I'm telling you, never buy a fixer-upper. Only buy good companies run by good people that have great cultures and pay fair market value for them. One of my best tips to people is do not hire talent for the company you have today. Hire for the company you aspire to be 5 years from now.
What's up, everybody? Welcome to another episode of the Tech Leaders Playbook. Super special guest today, Adam Coffey, best-selling author, serial CEO, and the private equity insider who's helped build and sell companies worth billions. Great books. I've read multiple of them. He's on a mission to pull back the curtain on how private equity really works and how founders can use that knowledge to scale, sell, and build wealth strategically. Welcome, Adam. Thank you so much for being here.
Hey, good to see you. Good to be here. Hello to all your listeners out there.
Let's go. So, Adam, I know we've got a hard stop, so let's jump in, man. First of all, I'm going to give you a name. Hopefully you'll accept it. You are becoming, in my head, the private equity godfather. So welcome to the
I like it.
Yeah, right?
It.
I thought you would. I've read a couple of your books. That's why I reached out. I think this is going to be a lot of fun. We're in the space as well. We know a lot about this world, but there's things I'm learning after 10, 15 years of knowing private equity that I'd never thought I knew. So thank you for being here. Let's jump right in. What inspired you first to write the first book, the Private Equity Playbook, and the Empire Builders, which was one of my favorite books?
Yeah, well, thanks. So, you know, to be honest with you, so I had been a CEO for decades, had been building companies for private equity. And, you know, and the private equity I was hearing about on TV didn't reflect the private equity that I knew and was working with, you know. So I'll tell you that the companies that I built had great cultures. We took care of people. And I learned that having a great culture and generating profits for shareholders, these are not mutually exclusive. You can actually do both.
Yes.
And so, you know, I had been working with, you know, private equity firms for a number of years, building companies, and, you know, a great run, you know, and having fun. I had been teaching at university, you know, for a while in executive MBA programs, mentoring a lot of up and coming, you know, future leaders of the business world. And so, you know, as I saw PE growing and becoming more and more of a force, you know, I thought, boy, entrepreneurs need to understand what this thing is, how it works, what its needs are, so that it can feed it. Yep. And take from it what we all want as entrepreneurs, which is we want to generate wealth for our families, right? And so I wrote that first book to educate a generation on this thing called private equity, which, by the way, when I wrote the first edition of that book, private equity, you know, it was at about 2.83 trillion in assets under management. When I started working with private equity, it was around 800 billion in assets under management. Wrote the book at 2.83 trillion, a little over 5 years ago. And by the time I put out the second edition of that book last year, we're over 7 trillion.
Wow.
I mean, I just saw a report from McKinsey a little bit earlier, you know, that you know, talked about PE eclipsing the $7 trillion mark. And I'm like, unbelievable, the phenomenal amount of growth. PE is buying 50% of all companies bought and sold on the planet. Wow. And it's because of their activity. Even if we don't sell to them, they've created the market.
Sure.
They've created the ability and the opportunity for tech entrepreneurs out there to really build something special and get a special return on that investment. And so, you know, as a result of that, you know, all my books have been designed to try to help educate entrepreneurs, teach them how to be successful, how to build a successful company in this era of private equity, in order to maximize the potential. That's kind of always been the stimulus. It was educate a generation about this thing called private equity.
Adam, I'm glad you mentioned private equity and culture, because there is a misunderstanding out there that all private equity run companies are just, you know, working people to the bone, and it's only for the exit. It's it's a flip sell. And the truth is, some of the companies do run that way, right? Because as a technology and go-to-market executive search firm, when we represent private equity owned companies, sometimes in the marketplace there's a little bit of that kind of bitter taste out there, because sometimes they don't do all the right things for culture purposes. But
anytime you've got tens of thousands of firms in any industry out there, you're going to have the good, the bad, the ugly, right? So it's going to be everywhere in between. But I'm going to give you a specific example. When COVID hit, I was running a company that was owned by Ares Management. Ares is the world's largest non-bank lender of debt, private equity.
Right here in Los Angeles, I know them.
Yep.
Was a client at one point.
Yep. And they also have a big PE arm, and so big PE firm, as well as a debt lender, also an equity owner of companies. And I remember when COVID hit, they started a foundation, a charitable foundation inside every company they owned. They seeded it with six-figure sums of money from their firm, their wallets, and said, CEOs, take care of your people. CEOs, when employee lives are impacted by this thing called COVID, deaths in the family, extended absences, whatever the horrific event happened to be, we wanted you to have a foundation so that you could direct money, and you can use your employees can donate to this, and we can convert vacation time to this. And, and it's like, you didn't hear about that on the news. Not. People don't talk about that stuff. We only talk about the horrific things, that happen. So as a result, I can tell you, I've experienced both sides. There are some great firms out there that care about employees, that care about people, that want to be good stewards, to the environment or the world, or just a generation. Just recently, I think it's KKR has really started creating equity programs where every employee in the company gets to participate in some of that value creation that's taking place. And so I'd say that while there are some bad firms out there, certainly in any industry there's
always good and bad people, bad and bad companies, great companies, bad people, good companies, bad people.
And you know what entrepreneurs need to do is a better job of doing diligence on who they potentially might be partnering with. And, as a guy who's bought 58 companies while running and building larger companies for PE, I can tell you that PE does way too much diligence. Entrepreneurs don't do any. They do very little diligence around, hey, what's this partnership going to look like post-close? And so entrepreneurs, if you're listening out there, who you sell to matters.
Especially if you're sticking around.
Especially if you're staying around, because it's the last time you'll have control, and it's more than just the absolute dollar. I think market competition will drive market value, market leading price. But, when you've got a pack of firms who are kind of at that market leading level, who you partner with matters, and that decision is up to you. And that's also, I cover that in some of my books too, just to talk about, how to pick a partner. What questions do you ask? What kind of diligence should you do? So, there is a lot to it. And so we can do a better job of picking as an entrepreneur, and picking a firm that's going to be good stewards to us, to our culture, to our people, and our legacy. So
I even like, Adam, how you specifically talk to almost the executive to going in to work for a private equity firm, and what questions they should ask and what they should care about and things like that. I thought that was really great, because no one's speaking to them.
Unless you do the kind of reps that I've done, this is shared learnings, through the school of hard knocks across decades. And I just wasn't seeing that kind of book out there. And so I was trying to engineer my own pivot. I was loving the teaching, loving the giving back and the mentoring of up and coming executives. Wasn't having as much fun after decades of doing it, just building one company at a time. I was kind of bored. I was looking for a new challenge. So I knew I was going to eventually pivot out of the CEO seat and start a consulting business, that was geared towards helping, founders and entrepreneurs at all levels find, and achieve higher levels of success. And I wrote that first book really to create the pivot. And I didn't get it done. I had just sold my company that I was running at the time, but it was Aries that bought it. And because Aries had been, with me on a previous empire that I had built, I felt an obligation to continue and, to go one more run, with them. And so I stayed. And so the second book actually wound up becoming the pivot. But it's been a great run. I had a lot of fun. I still work with private equity. I work with dozens of PE firms, and I do operating partner kind of work. But I'm working with 71 founders.
Wow.
And the number of industries I'm getting to touch today compared to just building one, running one.
Sure.
Now I'm working in dozens of different industries. And I'm absolutely having a blast. I work more hours than I did when I was a CEO, which I didn't think was possible. So for me, it truly was a pivot. It wasn't a semi-retirement, hang up your cleats kind of thing.
Yeah.
It was, I want to do something different.
It's more fun.
I'm 60 years old. I want to make an impact for my last 10 years, call it my career. I want to help entrepreneurs succeed.
You
That's
got a ton of
been
energy.
fun.
I could see you've gotten down to 20 years. Adam, let's talk about, you've got 58 companies, it sounds like, that you've been part of exits with, right? Acquisitions, and
Yep.
71 founders you're working with currently. And we could separate those two, but if you were to look at that portfolio separately or together, I know they were probably all successful, but what was the least successful acquisition, exit, and the most successful? And what was the key indicators of that success? Like what was it that led to one or the other?
Good question. So in my entire career, listen to this, entrepreneurs, in my entire career of working with private equity, I never lost money. Never lost money.
Wow.
My worst exit was a 2x multiple of invested capital, which is probably just a little bit better than the general broader stock market over the same kind of time frame. And my best exit was an 11x multiple of invested capital. And so my career batting average, somewhere around 4 to 5 times multiple, which those are really good returns. That's not typical. But I love to play in what I call as the lower middle market to solid middle market. It's like, I've run companies with EBITDA, earnings as big as 125 million, and billion, plus in enterprise value. But I've also run them as small as 15 million in EBITDA, and it's like the journey from 15 to 50, 50 to 100, that sweet spot, you're hoping to generate a better than 3x multiple of invested capital return. So for every dollar your investors are investing or the PE firm's investing, they're looking for $3 to $4 kind of as a return. And, and as an entrepreneur building the business for them, I'm sharing in that wealth creation. And so the amount of activity and the length of time it takes to go from, let's say, 15 million in earnings to 50 is a whole lot shorter than going from 125 to 250, and the magnitude of work to be done. So that for me, there's a sweet spot in private equity where I personally love to play. And those sound like big numbers. I'm sure there's a lot of small businesses that are out there that are listening, it's like 15 million in earnings. What are you talking about? Well, I wrote my books like Empire Builder to help people find those kinds of level of success. There's 34 million small companies just here in the United States, and only 7% ever get to $1 million in revenue. And only 4% of those that got to $1 million ever get to 10 million. And so Empire Builder was all about, how do you turn success into easy napkin math, into a programmatic journey that anyone can ride on to make sure that you beat the odds and become successful. And so trying to educate entrepreneurs at an earlier stage how to find, how to get out of the gates, how to find early success, how to build something that's scalable. Those are all, a part of my mission now. So while I still do big company stuff, I love working with, small entrepreneurs who are also just learning how to build a business for the first time.
Well, there's a ton of value between 1 million EBITDA to 10 million EBITDA companies, and these are legitimate businesses, right? Typically doing 10 to 20 million in revenue.
Yeah.
Nice companies, good brands, so tons of activity there. Adam, what was the That's good. But what was the key to the 11x? I know there's some macroeconomics. There's just how scalable the business is. Service businesses are a little tough. What was the key where your least successful exit, which was still very successful, to your most?
You want to know something that's interesting? Because, I'd love to tell you that it was about execution, but really what drove the 2x versus the 11x was macroeconomic conditions. The 2x exit came during the Great Recession. I'm building a company during the Great Recession. You're talking 08, 09, in that period through, and it's like back in that era, the results were somewhat tempered. There was some definite headwinds from an economic perspective. The 11x, believe it or not, at one time I had written down to zero. I thought this company's not gonna ever produce. And then, out of the blue, not only did, it was so tenacity, definitely sticking with something that was a turnaround, not giving up, not, getting knocked down, getting back up and saying, no, this company's not going to beat me. I'm going to win. I'm going to beat it. And so it's the mentality that I will succeed. I can succeed. I'll do whatever it takes to succeed. And then, as that exit was coming along, it was fueled by some strategics who decided to fight each other over, I want to own this asset. And so, we rode kind of, a really nice return on some of those kinds of factors. But in that particular case, at once upon a time, I had actually written down the investment to zero. The 2X, it was a great company, a great culture, really great performance numbers. It got caught into by some economic headwinds.
Sure. I remember that time. It was very tough.
So I'd say it was less about my execution, more about, hey, what industry was I in at the time? Sure. And so one of the lessons learned that I try to also lay out, in Empire Builder is to talk about, if I don't own a company today and I'm just starting out, what type of company, what type of industry generally is going to provide more safe harbor in a bad economy that might allow me a better upside in a good economy? Because in a great economy, all companies, all people can make money. Sure. It's when the economy goes south that certain companies, certain industries do better than others. And can I create, an economic engine that's resilient in the face of a tough economy? I was CEO when planes flew into buildings, the Great Recession, the pandemic, so many different kinds of turmoil and change that the world can throw at us during wars, things like that. And so we have to forever be adaptive as entrepreneurs, but there is certain DNA that says I'll have a higher probability of success if I'm in this kind of company versus another kind of company.
Right. So if we throw those two out, the 2 that was in the toughest times and 11 that might have been the best of times, give me 3 key areas or fundamentals where you're like, these companies did well for these reasons, these companies didn't do as well for these reasons.
Yeah. So if I just say, what's a good profile of a company? I want a company that's satisfying fundamental needs, not wants. So needs versus wants, right? I need my roof fixed when my roof is leaking.
Yeah.
I want a new set of tires for my monster truck, out in the driveway. I want a new, a sport coat because I'm going out to dinner. But if the economy's tough, if I'm laid off, if I don't have much discretionary income, well, guess what? That ratty old sport coat I've been wearing for years is going to do just fine, and so you can forgo expenses if it's a wants-based company. You can't really forgo expense if it's a needs-based company, even in a tough economic condition. So needs versus want. I like recurrent revenue type companies versus project-based companies. So I mentioned roofing as being need, not a want, but it's project-based. Adam needs a new roof this month. Adam won't need one next month because Adam only needs one every 15 years or so. And so the company has my revenue this month, it goes back down to zero, needs to find a new Adam just to get back to where it was. But if I had a recurrent revenue company, a couple examples, pest control, landscape maintenance, bookkeeping, accounting, payroll services kinds of companies. It's like these people, when they become a client, very sticky revenue, build monthly, recurrent revenue. When I use marketing to find a new person, it adds on top of the pile I've already got. So I'm not replacing revenue. I'm replacing churn, but I'm not replacing all revenue like a project-based company. So needs versus wants, and recurrent revenue versus project-based revenue. Second thing for entrepreneurs out there, low capital expenditure, high free cash flow conversion. Think about a payroll services or an accounting bookkeeping firm just for a second.
Yeah.
What's the product?
None.
It's my head. What's my capital expenditure? I got a computer, not a lot of money. Compare that to a heavy construction company that's got to buy dump trucks and bulldozers and earth movers. And it's like, if it's low capital expenditure, then I'm generating a tremendous amount of free cash flow. My consulting business is about a 90% free cash flow net profit business. And so very little, capital expenditure. My head is the product. And so if we're buying a company, instead of launching one, or even if I'm launching one, it's going to take less capital to seed and to build, a company that's got recurrent revenue, needs versus wants, and it's got low capital expenditure, very high free cash flow. I'm going to be generating positive cash flow very quickly. And so there is a profile out there. You can be successful anywhere. And God knows the companies that I've run did not meet all of my criteria. And those that checked more boxes tended to do better than those that didn't. But I made money in all situations. And so you can make money anywhere. Rising tide lifts all boats. But it's when the economy goes south, and it does move in cycles, that a better built company weathers that economic storm better, and it grows faster, has more predictable revenue streams.
Huge.
And so there are profiles to success. And, a lot of times we wake up and it's like, we're in a, if I already own a business, I'm already there. I've already made a choice, whether it was good or bad or indifferent. And so I need to learn how to maximize the potential of what I've got. But if I'm starting from scratch, young entrepreneurs out there or older who are transitioning, two things I'd tell you, 2 words of advice. One, think carefully about what kind of business you're going to start using that framework I just laid out. But number 2, consider buying an existing business rather than starting from scratch. Right now is the largest wealth transfer in human history. As baby boomers, I'm the youngest baby boomer, I'm 60. As the baby boomer generation is retiring over the next 10 years, all of these founders and business owners will be transitioning out, and you can buy a business using the cash flow in the business to service the loan, and you've already eliminated all startup risk. You've already bought a company that's beat the odds, was one of the 7% that got to $1 million, potentially one of the 4% of those that got to 10 million, has a history and track record of operating during different economic cycles. And it's like you can totally eliminate all of the startup risk. You'll have a few risks. Can I keep the customer base? Can I transition? Can I continue to do well in the world of changing AI and all these other pressures that are out there? But at the end of the day, it's like, those are my 2 pieces of advice. Follow a framework, companies that do better than others to start. Secondly, consider buying something rather than starting from scratch. And a lot of opportunity out there.
Especially with unsexy businesses. Tons of kind of needed businesses are run by individuals who are going to be
I
retiring.
love businesses that are not sexy. I have billions of dollars in exits in businesses that aren't very sexy.
Amazing. Sexy, unsexy is the new sexy. Adam, one of the things that we did, realizing exactly what you talked about, is our kind of executive search recruiting function is a higher margin business, but it's exactly what you remember. Every month you're starting over. So you have great months, you have bad months. So what we did is we built our consulting, our staff augmentation side of the business, where we have recurring revenue, and it pays most of the bills, and the rest is hopefully gravy.
It's really interesting because even in your industry, I've seen it morphing. It's changing. And I work with some staffing and recruiting agencies in Europe, and the model is different. There is a lot more recurrent revenue and a lot less project oriented. So over there, they're getting embedded in companies. Companies are paying monthly fees, and the monthly fees include some base level of recruiting based on kind of their historic need over time. And so they're taking over. It's almost like the outsourcing of the
Sure.
not the HR function, but the hiring
It's a talent
function.
acquisition function. It's
Yeah, the
almost
talent
become a
acquisition. Yeah,
BPO, right? In a
yeah,
way. What? Yeah.
and and very recurrent revenue streams that are kind of changing that profile away from
That's what it's all about.
I'll call it the project base. And we see that with so many different industries. Think of just like a car wash, a coin operated car wash, or a car wash you would go drive through when your car was dirty. And now it's like I've got a sticker on every one of my cars, and I got a lot of cars, and that lets me just drive through the car wash anytime I want.
Yeah.
And so they're hitting me up with a monthly recurrent credit card charge.
Mm-hmm.
And so there's an industry that transitioned from, point of need, point of sale to recurrent revenue monthly. Come when you want, and if the weather's nasty and you don't come, I'm still getting paid.
Sure.
And so a lot of industries are morphing and changing. Accounting. I'm working on accounting roll-ups right now, and the old school bricks and mortar companies, run by a 70-year-old who wants to retire, probably has bricks and mortar and all their clients within a 30-mile radius, and they bring in shoe boxes full of stuff and say, "Do my taxes." I look at the younger generation and the next generation of accounting, tax, and bookkeeping services, and they're virtual. Clientele can be anywhere. And so much broader, I don't need the bricks and mortar. And so there's like all these different industries out there that are morphing, and people are reinventing them, is what's happening. I even have, just in a high-end shower, cartridges that need to get replaced because they're filtering the water, and my wife wants what it does to her hair, and so it's like every month or two, it's like I get a box, and I go change these cartridges, and they're soaking me for $150 on my credit card, and it's like everything has gone to a recurrent model.
Razors to shower heads. I know what you're talking about. We just installed one. Didn't like it, but we installed it. What are the most misunderstood fundamentals around fund structure, investment timelines, and how PE firms actually operate and make money?
Yeah. So first of all, I'd say the majority of so first of all, a PE fund lasts for 10 years. The PE firm has 6 years to buy companies and deploy its capital. Average hold period's about 5 years. It then has to return all capital, it has to sell the companies it's built, has to return capital to its investors. So it's a private fund. There's no liquidity. So we're working with a very short time window, first of all. And I think for entrepreneurs, this is great because we earn our money when private equity sells. And then the next firm comes in and we can recharge, roll over, take some money out and go again. And so the faster I can sell that business and get it to grow at a pace that's sexy, the more paydays I can get in a fixed time period. So I'm all about, if I can get an exit every 3 years, that's better than an exit every 5 or 7 years, because in a 20-year career, I can get 7 instead of 4, and so that's how we get paid. So it's understanding how PE works and how it's wired, and then feeding it and giving it what it needs, and working within its own limitations on these different timeframes. And so I think a lot of entrepreneurs don't understand, again, I'll go back to, they don't understand the basic fundamentals. And so they don't know how to be a good partner or steward to private equity. And, as a result, there can be kind of a misalignment in timing. Sure. And it's like an engine. If the timing's off, the cylinders are firing at the wrong time. It's like we don't get as far. The car runs rougher. It's like we really got to become, well-versed in understanding, hey, I can learn so much just by asking a few questions. If I'm looking at an entrepreneur, and they're selling a company and I've got a fund coming in, one of my early questions are, it's like, what year was the fund established? And what year did the fund make its first investment? Maybe it was a 2020 fund and it's buying late stage, it's buying 2025, a company in 2025. Well, I know it's only got at most 5 years left before the fund's up. So, I'm going to be a relatively short hold period. I talked to an entrepreneur, hey, when did your company sell? Oh, my company sold in 2019. Well, who was it sold to? It was a PE fund. When was that fund established? 2016. Well, guess what? This is 2025. You're out within a year because they're running out of time. So it's like just understanding the basic mechanics of how this industry is wired and put together helps us be more efficient at how we interact and work with it. And that often leads to what I'll call the better outcomes.
So IRR, I'm guessing, is one of the most important, if not the most important.
Today it's IRR.
Mhm.
So I'll give you an example. I ran a company. The last company that I ran when I sold it the first time, I literally ran it for 27 months. The PE firm owned it for 3 years, but they hired me after they had already bought the platform. And at that time, we had bought 8 more companies. We had engineered a 4x multiple of invested capital. The IRR was 56%. But this was a relatively new fund. So why would they sell it early? Well, they sell it early because about every 3 years they raise a new fund. And if they're 3 years into their last fund and they can get a quick 56% IRR, then they can go to their limited partners and they can say, hey, look at the first exit on our new fund. It's a 4x multiple of invested capital. It's a 56% IRR. Invest in my next fund. Hurry up and get you some. So it's like a billboard that says, look at how good I am. The companies that get held the longest are usually the ones that underperform.
Sure.
And so they have this delicate balance between managing the money return, the multiple of money versus the IRR. And because limited partners or investors are comparing what they're getting from a PE to the stock market, and the stock market over a 30-year period, averages about an 8% return, IRR, which is a similar valuation, kind of metric. The world of PE is going anywhere from 16 to 30% IRR, and that compares to the 8% the stock market's doing. And so that's why IRR has become kind of the lead metric. It's like I have alternatives, and I think about them not in terms of multiple of money. I think in terms of what's the percent return I'm going to get.
Sure.
And so IRR is kind of the how the world of PE gives you a measurement that's relative to this stock market kind of return. Family offices are more focused on multiple of money. And that's simply because they are not raising funds from limited partners or investors. They're investing their own money. So you think of like Michael S. Dell, MSD Capital.
Mm-hmm.
Michael Dell is worth like $66 billion. He doesn't need to raise money from investors. So he has his own private equity fund, and he doesn't think in terms of IRR. He would think in terms of, hey, I'm putting a bunch of capital to work. Give me a high headline IRR, doesn't do me any good. I got to turn around and find something else to buy immediately after. So a family office tends to focus more on multiple of invested capital, money on money return. But traditional PE firms are more rated by IRR because their investors are comparing to the stock market.
Adam, the stock market's one thing. How about when investors are deciding between joining a VC fund versus a private equity fund? What are the key differences there, and what should be considered when focusing on one or the other?
So if you think about just the basic types of PE funds, so the largest segment is called a buyout fund. And so a buyout fund literally buys out or has to take a majority control stake in the companies that it's investing in. And so that's the largest category of PE funds that are out there. So sometimes entrepreneurs will tell me, Adam, I'm thinking about selling a minority stake because I want to stay in control. And I'm thinking you're going to get hammered because there's so few minority investors out there that they don't have to pay the same kind of multiples a buyout fund is. So you think you're going to have control, but that minority investor is going to have their own shareholder rights agreement, and you're not going to be as in control as you think. But you're going to get a lower valuation, lower multiple. But buyout funds, biggest category. Debt funds, next biggest category. Debt funds is, predominantly it's mezzanine capital is what it's called. So it's second to bank debt or commercial lending, but it charges a higher interest rate, and it tends to get warrants or some extra. It gets a little piece of ownership in the upside where it loans money to. And, so that's also a form of private equity. So I got buyout funds, largest segment, and then PE debt funds are next. Then you got venture capital. So venture capital funds are a form of private equity. And generally, though, buyout funds are looking to hit more singles and doubles. They're buying mature companies, controlling stake, mature industries, long track record of revenue and earnings growth, not going to get as big a home run, but more consistent results, on every investment. Venture capital, we're looking to hit a home run every time. It's like home run derby. We get up to the plate, we're going to strike out a lot, but we're going to hit the occasional home run. And so a lot more volatility.
Sure.
And unfortunately, for listeners out there, VC funds seem to be the easiest and most accessible to smaller investors. Buyout funds, debt funds, you got to invest $5 million minimum pop to be an investor in a PE fund. Venture capital, I see them all the time, 50,000. It's like these are small entry points. And a lot of people are like, oh yeah, I'm going to get to play. And I'm like, you better read that prospectus or investment circular very carefully, because the historic average of VC funds isn't better than the S&P 500. There's a time and a place for venture capital, and there's a time and a place for buyout. And so someone who's got a diversified portfolio would include elements of all. But for someone who can only make one investment, that's probably the most riskiest part of private equity, is the venture capital, because we're looking for home runs.
Yeah, 9 out of 10 are usually failures, right? 9 out of 10
Yeah.
companies, but
We're investing in an idea
Yeah.
in venture capital.
Oh, yeah.
In buyout, we're investing in mature companies with a history of earnings and revenue.
Sure. We talked earlier buy versus build, right? How can someone new to acquisition start exploring this path strategically, especially when they're not in this? Let's say we're buying, I don't know, a AC company, or a plumbing company, and I'm in tech. How does someone like that start looking at those industries?
I tell people to do research. So thesis-based investing. If we have an interest in an industry, so again, I start with a framework. What's my framework? Needs versus wants. Recurrent revenue, not project-based. Low capital expenditure, high free cash flow. I set up a framework. I start thinking about what industries, and then usually for an entrepreneur, I tell them, get out a piece of paper, make 3 columns. Column on the left, where are my skills? What am I good at? I'm a great salesperson. I'm a good motivator. I'm very detail oriented, whatever these skills are. Think about passions in the middle. What do we love doing? And then what industries might we align all of these? It caters to my skill set. It feeds my passions. It's not going to be as much of a dredge when I'm getting up and going to work in the morning. What are the industries? Then I take those industries and I apply them to my framework. How many of those? Give them a checkbox if they're needs versus wants. Give it another check mark if it's recurrent revenue, not project based. Give it another check mark if it's low capital expenditure, high free cash flow. And so I'm starting to kind of guide myself. But then I need to do research on industries. And I need to understand, hey, if I'm going to buy a bunch of companies, is it a fragmented industry? And so there's tools out there that we can use. We can do basic research. But if I want to know how many companies there are in an industry, I might use Dun and Bradstreet's tool called Hoover's, which is only about $600 a month, and I can search by NAICS code or SIC code. It's like, show me. I just did this. I'm giving a speech tomorrow. How many automotive repair companies or shops are there in the United States? Well, guess what? It's 2.9 million. There's tons of them.
Wow.
And so I can size up an industry using a tool like that. How much companies sell for? Business Valuation Resources has a tool called Deal Stats that I use every day. And by the way, I don't own stock in any of these companies. I'm just talking about tools I use every day. And that one for about $1,200-$1,300 a year, I can look up industries and see how much companies of a different size with based on amounts of revenue and earnings, what they actually sell for with real transaction, a database of real transactions that have taken place. And so I can start developing, I don't want to pay too much, and based on that profile, then, I can kind of calculate what would my debt be to buy it. Do I get enough free cash flow in that kind of business in order to support the debt, with minimal equity, which is what most people tend to not have, is a lot of their own equity. And so, it's like, there's a lot of work I can do to guide myself to the right industry or the right company. And, the answer may be different, for a lot of people out there, just based on our own skills and passions and the things that we enjoy doing. And so, but by putting some work up front, doing some research in the industry, there's a company out there called iBiz World that does a lot of industry reports, and they're expensive, they're not cheap. But if I'm truly thinking about buying a multi-million-dollar company or making a huge investment, I might want to spend $1,000
Sure.
to get an industry report to find out in 100 pages everything there is to know about this industry. How big is it? How fast is it growing? Is it got tailwinds pushing it? Is it got headwinds? And
Sure.
What are the prospects? And I call it thesis-based investing. We want to create our own thesis. What's the industry? Is the industry growing? Is it shrinking? Why do we want to pick this industry? It's like we want to convince ourselves and potentially investors or banks to back us. We better do our homework, and we better put some time and effort into researching an industry that we might think. And I tell some people, if you're young or you don't have a lot of personal commitments or financial commitments, hey, why don't you go work in a company in an industry that you're thinking about running and see if you like it, and learn about everything to do or not to do while you're getting paid by somebody else before you peel off and go buy your own company. Get a chance to kind of walk in the shoes of a business owner, in a certain industry, and see whether or not it's something that appeals to you. And so just like we talk about, you need to do some work to pick the right PE partner, you need to do some work too to find the right company, the right industry, to go into. Sure. And if you do these things, your chances of success are just so much higher.
Well, you're de-risking what you're going to invest in. Adam, question for you. A common sense, or my gut would say, and it could be wrong, and you tell me, is like one of the things I want to see in a business that doesn't have every one of those check marks is, there's meat on the bones. You've built a nice, successful business, but you have no recurring revenue. I am confident that if I can add or pivot into a recurring revenue model, then man, we can 10x this business. Or are we kidding ourselves when we're thinking about these things, and we should only look at those companies that have that figured out?
My casual advice, and remember something, guys, I'm a turnaround expert, right? So, started at GE in the Jack Welch era and learned how to troubleshoot and fix underperforming business units. Every company I ran and built for private equity started as a dog with fleas that was disappointing somebody, somewhere, and it wasn't earning, wasn't growing. So I'm a turnaround person, and I'm telling you, never buy a fixer-upper. Only buy good companies run by good people that have great cultures and pay fair market value for them. You're going to get your growth. A lot of entrepreneurs make the mistake. They think that they're going to generate their returns by buying something that's distressed and fixing it. That's not where the returns come from. The returns come from buying a good company and scaling it larger. And when I get larger, again, 34 million small companies in the US, only 7% have $1 million in revenue. There's only 3,000 companies on the entire planet that have $1 billion in revenue. Wow. And so you go from 34 million at the bottom of the pyramid, up to 3,000 at the top. Globally, there's hundreds of millions of small companies globally, but in the US, 34 million. The magic to returns does not come from fixing something that's broken. It comes from taking something that works and making it bigger. Wow. And as it becomes bigger, you are climbing up to a stratosphere where there's not as many companies of your size, and you're rewarded with what's called multiple expansion. So an example from my last empire, I bought 23 companies in an industry, and on average, I paid 5 times EBITDA, or 5 times earnings, for each one of those businesses.
Wow. So those are good businesses with great multiples.
And when I sold it for 14 times.
Wow.
So for every $1 of earnings I bought and paid $5 for, I then turned around and sold it for 14 once I put the companies together. And so my profit came from getting bigger, not from fixing the companies. When I start fixing dogs with fleas, I get bogged down in a turnaround, and that takes energy away from me just finding more great companies to buy, or it takes energy away from me scaling my business that already works. So I tell entrepreneurs, if you want to avoid headaches, recognize where the value is coming from. Yeah. It's not coming from you fixing something that doesn't work. It comes from you growing something that does.
Adam, I hate to bring this down to people, but I don't know. There was a LA Times interview that I did, and it talked about how draining it is to try to motivate and change C players, right? Because it's like, oh, if I work hard enough to make these C players into Bs or As, oh my God, imagine what's going to happen, and you end up just you become demotivated trying to motivate them into doing something they never intended to do, never really wanted to do, or aren't skilled enough to do.
Versus
It's the same
upgrading the
thing.
talent, and
Yes.
making a tough call, right? Yeah.
Yeah. So in
Yeah.
this case, no, just hire motivated A players and scale their careers. Help
Here's
them
here's
win.
here's something else since you're in that industry.
Yeah.
One of my best tips to people is do not hire talent for the company you have today. Hire for the company you aspire to be 5 years from now. So if I'm a flat company that's stable and not going anywhere, I can hire for the company I've got today. If I'm growing at 30%, which is what my companies do, then the company that I'm going to be in 5 years is 4 times larger than the company I am today. If I hire somebody whose capacity is where I'm at, I might have to turn over that talent again. I'd rather overpay to get a higher level of talent in a key job. And I'm going to ask that person, please help me fight below your weight class. I'm on a growth tear. You know what big looks like. You know where I'm going to be. Help me get there. And what I'm looking for is 10 years or more of talent capabilities. So if I ask someone, to fight below their weight class, and I catch up to their weight class in the first 5 years, the next 5 years, I'm pushing them to new heights. But if I start by coming out of the gates, pushing someone to new heights, in 10 years, I've outgrown their talent, or could, the risk is there. So I tell people, you need to make sure that you hire talented people that have the skill set you need based on your growth trajectory, and they can serve you for a longer period of time because they know what bigger looks like, and they can help you build that. And so on key talent, overhire,
That's
not
huge.
underhire. You know,
Adam, one thing I'll add to that, since we're in the business, is you got to be careful though, because a lot of times people get people from big companies because they're like, wow, this person's, at a much bigger company where I'm trying to get. The key here is you have to determine, did they help that company get to that level, not just work there, one,
yeah.
right? And then
Can they
two,
roll up their shirt sleeves and get it done without a big staff around them, right?
yes, are they
Yeah.
scrappy enough? Number two, Adam, are they willing and able to do it again? Some people have
Yes.
worked their ass off and they've done it. I don't want to do that again. I've made it. Why am I going to come do this? So you got to be really careful. Those people are,
That's where long-term
ooh,
incentives,
yes,
come in. Hopefully, so I would say so. That was a definite. You hire a general manager from the Fortune 500 world. There's two kinds. There's the kind that knows how to roll up their shirt sleeve and get dirty, and help get into the weeds in a smaller company that doesn't have the resources. Then there's other people who are brilliant minds and great, at strategizing and tactical execution, but they can't do it themselves. They need a team of people around them. And so they're the brain bug, but they need a whole bunch of people who can make it happen. And if you're going into a small company environment that doesn't have all those resources, that kind of general manager would struggle or fail. So it is, to your point, recognizing, is this talent capable?
and willing
And
so a
willing.
lot of
Yes.
times, Adam, with our clients, where we have to educate them on the mistake they're making, because they're looking at, well, those guys did it, well, that person didn't do it, so be
Yeah.
careful, and they might not be willing to do it even if they did it. So that's the key, right? You got to look for that alignment.
Another area where a lot of my clients, lately, it's like we've been I've been sending them to recruiters is, so I post a job on LinkedIn and I get 2,500 replies. How the hell, as a small HR department, do I sift through 2,500 potential candidates or 1,000 potential candidates and get to the ones who are real,
Yeah.
and potentially could be game changers for me? And it's like, recruiters help with that
Of course.
process by triaging all of that.
Well,
So
besides the triage, Adam, there's one misunderstanding about executive search firms or recruiting firms is, if they're good, they're not going through 2,500 people.
Yeah.
They are market mapping. Like, we market map and find the people
Yep.
you need, not the people that are looking for jobs. That's
And so
the
when a
one thing.
company does it, though, my point is they
Of
get
course,
everything under the kitchen
I
sink.
call it the post and pray. It's the post,
Yeah.
and it's comfortable. Frankly, I do it sometimes too, because why not? Let's see if we can get lucky, but it's not the right strategy usually. Let's talk a little bit about, we talked about how of the 34 million companies, only you said 7%, right?
Yeah.
Are, make it to a million, which isn't much. And then just 4% of that make it to 10 million, right? At 10 million, you become a really good profitable business if you do it right. Why is
Yep.
that? What mistakes or blind spots are preventing these companies from scaling to profitability?
Yeah, it's a well-intentioned entrepreneur doesn't know what they don't know. And so I talk a lot about unit level economics, and a lot of entrepreneurs that I talk to or engage with, they tell me, Adam, I'll figure out how to make money when I get bigger. They think it's a revenue problem. And I talk about unit level economics, and in my books, I use the fictitious landscape maintenance company. So, what's the unit level? What's the smallest level of revenue production in any company, any industry? And in the landscape maintenance business, it's one truck, a crew of two people, and they have a weed whacker, a lawnmower, and a blower. It's like that's my basic unit level.
Sure.
How many lawns can they cut in a day? How many lawns can they cut in a week? How many weeks in a month, months in a year? If I'm seasonal, maybe they got to switch over to snow plowing. It's like, how much revenue can I produce at the unit level? Once I figure that out, I build another model, and that's called my expense model, which is what is the salaries or the wages of those two people, the benefits component, what's my gasoline, and operating expenses for that truck and insurances for the truck and, all that stuff, maintenance reserves, and I have an expense model. I got a revenue and expense model. And I talk about this thing I call the 30-20-10 rule. A business needs to generate at least 30% gross profit. Its cost of customer acquisition and back office, or SG&A, sales and general administration, needs to be under 20 cents, because in order to be viable, we need to make at least a dime on a dollar. And so I'm building a revenue model, an expense model, and then a capital expenditure model, because growth costs money. I need to understand how much money am I going to need, to put more units of my unit level economics out in the world. And then I create what I call as napkin math. So my nephew literally is building a landscape maintenance company, and he had never read my books. And so I gave him my book, Empire Builder. And I'm like, well, it just so happens, nephew, this book was written for you, and it talks about building, a landscape maintenance company from 0 to $1 billion. And then I worked on him with his own models, and then we created the napkin math. And so in the book I use, it's roughly 198,000 in revenue is the revenue model, 126,000 is the expense model. I'm going to make 36%, gross profit. And if I can keep my SG&A at my level of 20 or less, I'm going to make 16 cents on a dollar. How many trucks do I need to get on the road in order to pull that off? I'm going to need 6. So how many clients do I need? 425. And so I created napkin math for my nephew, who's not the smartest business guy in the world, but he's very dedicated to what he's doing. Retired Air Force, guy. And it's like I told him, every time you add a 76, you get to your 76th customer, buy a truck. You and your partner split, you each go into a truck, you hire a helper. When you get to 75 more clients, take the best helper, give them a truck, hire another helper. Now I got 3 crews. And it's like, and when you get to 6, you're going to have $1 million in revenue. And when you get to 51, you're going to have 10 million in revenue. A company must work small. If it's not working, if it's not beating 30-20-10, I don't even worry about scaling. Forget scaling.
There's nothing to scale.
There's nothing to scale. We're not going to find profitability down the road. We need to find it early.
Wow.
Identify the unit level economics, have a revenue model, an expense model, a capital expenditure model, and then figure out how many customers I need to get to 1 million, how many customers I need to get to 10 million, and then create napkin math. Every time I sign, 75 clients, I buy a truck. By the time I have, 6 trucks on the road, I'm over 1 million in revenue. It's like I gave him the napkin math because he can understand the napkin math. And so that's what his focus is. He called me the other day, hey, uncle, I got one more customer and I'm buying another truck. And I'm like, now you're winning. If we work small, we'll get better as we get bigger. Let's be honest. If I buy 51 trucks on the road to 10 million, I'm going to get a better price than if I buy one. If I buy 51 lawnmowers, I'm going to get a better price than if I buy one. It's like, as I'm getting bigger, I should actually be becoming more profitable because I'm creating what's called operating leverage. But if it doesn't work small, it's not going to work big. I'm going to take a small problem, make it a big problem, and that's when I'm going to find financial ruin. Fail small. What do they say in startups? Fail small,
fast.
fail fast, fail often, right? So if my unit level economics don't work, I work to fix them. If I can't fix them, move on. Time to do something else.
Wow.
If I can make it work small, guaranteed, if I pass 30, 20, 10, I can build $1 billion business.
Ooh. Adam, I have so many more questions, but I know we're tight on time. Next time, I'd like to ask you when a company business is exit ready. That's another. I almost want to do a version.
Oh, let's do that. Let's put that one on the calendar.
Let's
we can talk
go.
about exits.
That's too important, right? And that's where they potentially need you. Adam, give me one book other than yours that you would recommend.
I've read a lot of books over the years, and so I think one of the biggest problems that entrepreneurs have is accountability. If I'm a CEO and I'm not hitting my numbers, my board's going to fire me. If I'm working, at GE in the Jack era, if I'm not hitting my numbers, guaranteed, I'm getting whacked, right? It's like there's accountability. There's a lack of accountability in the entrepreneurial world.
Yes.
And so, any book that I can read on leadership and accountability, would be one in my wheelhouse. I like the classics, I'll say I like EOS, I like Traction.
Yeah, I do too.
Because I think all companies need to be focused on continuous improvement,
Yes.
and that's what the EOS system is. We need a system. We want to build a better company every day. And my only limitation on that is I'm building a better ship every day while I'm sailing it, but EOS doesn't tell me where to go.
Yes.
It doesn't take.
It's got its limitations. Yeah.
Yeah, it has a limitation, but we all need a system. But I also like the classics. I like stuff like Jim Collins' Good to Great.
Yep.
I even like The Millionaire Next Door, which is going back a ways. Learn what a millionaire really looks like. What does a successful person look like? Because it's probably not the guy in the Ferrari that you think.
Or the TikToker, right? Bragging.
Right. And then I'll also say, so many companies out there are just dealing with red ocean. So we're a race to the bottom. We're in a very competitive industry. There's a book out there called Blue Ocean Strategy. Another oldie but goodie. How do I take my existing business, which is racing to the bottom, lowest bid wins, and make little strategic pivots to reposition it to be in blue ocean? Red ocean from the blood of competition versus blue ocean where I've got clear sailing ahead and revenue growth ahead. So learning how to take a business that's now struggling and redefining what it does and who it does it for, also very germane. So I'd say Jim Collins, Good to Great, Blue Ocean Strategy, Millionaire Next Door, Traction, books like that.
I've read them all except Millionaire Next Door. We are an EOS company, and it really helped us go from a practice small business to a real company with accountability and work charts and accountability charts, and we still have our own challenges, but that was a really good start. Adam, thank you so much for helping us unpack the real story behind private equity. There's so much more to talk about: business failure rates and exits and surprising opportunities ahead. Listeners, check out Empire Builder. That's what I started with, and it was kind of inspiring. And now I'm looking at the private equity playbook version 2, like you suggested. And then I'm looking forward to the exit strategy playbook. Learn more on Adam, Coffey, or on LinkedIn. Right, Adam? That's where you
That's it. You'll find me on LinkedIn. Just me, not a team of people answering my inquiries. It's me. You get me on LinkedIn.
Man, learned so much. Adam, thank you so much for doing this. I'm going to come visit you in Dallas, and maybe we'll do the second one live.
That'd be fun.
Let's do it. Thank you so much for being here. Appreciate it.
Thank you.
And that brings us to the end of another great episode of the Tech Leaders Playbook. I want to thank you for joining us and hope you took away some valuable insights to apply in your professional journey. Don't forget to subscribe on your preferred podcast platform so you don't miss out on the next great conversation. I promise it'll be good. If you enjoyed today's episode, we'd appreciate if you could leave us a review. Your feedback not only helps us improve, but it also helps others discover the podcast. Better leaders mean better working environments. Better working environments leads to happier people. Remember, a rising tide lifts all boats. I'm Avita Santablian, and this has been the Tech Leaders Playbook. Keep leading, keep learning, keep giving, and I'll see you on the next one. Until then, stay inspired, my friends.